to gather we have this interview.
Right.
So
So I've started the recording.
yes,
Perfect.
sir. First, I would like I'd ask you to interview.
Introduce.
Not interview. Give an overview of what you do.
Okay. So we have two practices. One is where we're doing training basis the consulting experience that we have gathered over so many years, and also the consulting projects that we get engaged in. Now the question is, what kind of consulting activities we take up? So we are largely on the um, financial due diligence kind of a job that we take up for factories, for our clients, for promoters, and we act as a bridge, just an extension of the services that we give. We act as a bridge between the merchant bankers and the promoter. So when a merchant banker is trying to find or look for a promoter in a certain sector, or the promoter is looking for a merchant banker from an SME IPO perspective. So all we do is read, analyze the financial statements, and try and figure out the red flags or challenges, understand the business model, whether the company is investable or not, whether the company can go for listing or not. So that's the whole consulting side of the business. Yeah.
Sir, I'd like to understand how you typically approach a stock selection. Like how it evolves from the initial interest to an actual investment decision
Yes.
in your
First
experience.
is it selling at a reasonable price? So we use RSI and price to earnings to filter price stocks which are trading at a reasonable value. Point number one. Second is we look at uh, companies which are asset efficient, because companies which are not asset efficient will not generate revenue.
Hmm.
It is the base or the underlying of the asset which generates the revenue. Point number one. Okay. Then we look at the inventory management principle. Once we have produced or are in the process of production, it is the inventory which matters. How the inventory flows from the raw material to semi-finished to finished.
Hmm.
And then we look at what you call as we look at the cash flow. So assets under utilization, generating profits or not, inventory under utilization or inventory turnover, inventory under management, the inventory flow, and then whether the inventory flow leads to cash flow or not. So these three pillars of finance is the core pillar of my understanding. It comes out of my experience of looking at factories, visiting factories, evaluating factories. So for me, financial ratios are decided or are sort of these are actually uh, formulated at factory floor or service floors. It is not something that is done at headquarter level.
Hmm.
Your asset lies in the factory, your inventory lies in the factory, and when you sell the inventory, the cash comes out of it, the cash flows out. So all these activities are factory related. So a visit of the factory is very, very.
Okay. So the next question is, when you go through a company's financials, which area gives you the most insights that shapes your evaluation of a business?
Very good question. Again, based on what I just said about the three principles, one is I would look at the first thing I would want to compare is uh, sales to receivables, sales to CFO, sales to inventory, sales to ROC, and sales to ROIC.
Okay.
These five factors, whatever, can just count them. Um, these are the factors that I focus on, and I think it gives me the maximum insight. It gives me the maximum food for thought. It gives me maximum pointers, and most of the red flags lie within these.
Okay. So, have you ever come across a situation where the reported numbers look strong, but You had an intuition that something is
Yes.
off. So how do you identify and what are those red flags that come?
Cash flows.
Cash flows.
The
Okay.
numbers looks absolutely perfect. Then my main question is why have the prices corrected?
Hmm.
And you'll find the answer in the cash flows.
Okay.
If you think that everything looks hunky and hunky dory, then what is the reason for the correction? The problem is in the CFA books, in the MS Finance books, in all certification books, they are asking you to do fundamental analysis, Karuni, but
Hmm.
they're not saying, they're not linking to the prices. They are saying the technical prices is something different, and as fundamental analysts, we are not bothered about it. Whereas all you are working, when you're working on fundamental analysis, you are trying to derive a valuation number, which is a bookish number. But at the end of the day, you're trying to find the correct price.
Hmm.
When you are looking at the technical prices, you are actually looking at the price. So price is the ultimate truth. So it is a techno fundamental analysis.
Okay.
And we are in a technical analysis class, we are not talking about fundamental analysis. In a fundamental analysis class, we are not talking about technical
Technical.
analysis. I think it is the biggest stupidity on the planet. In a fundamental analysis class, you have to talk about prices. So the first question is, if you present me a company which looks so interesting, then why are the prices subdued? Why have the prices been hammered? Why have the company's stock prices got a hammering? Is my question. And from there on, we find out that what are the reasons why it looks hammered out. I mean, we figure out the reason.
So next, I want to ask you about forecasting. So when we talk about forecasting, it comes with a lot of uncertainty, right? So how do you manage your analysis and how do you deal with uncertainty?
Averages. It's a game of averages. So people will give you three scenarios, which I think is a bogus understanding of financial statements, right? And I can say this after 15 plus years of experience. Like
Hmm.
you, I started with scenario analysis in my earlier days, and this is something that I really used to like because it was also a function within a Excel sheet, which was spreadsheet, which was exciting. Within MS Excel, this was a function called scenario analysis or goal seek. But as time progressed, I realized that none of the assumptions come true. Neither your optimistic assumption, neither your worst case assumption, neither your base case assumption. It is a game of averages. And the methodologies which are proprietary in nature, which we have evolved, which we have worked on, and which we also train on some of our bright students, we look at it's a game of averages. So you have to try and figure out what the average looks like before you think about an outlier. People think about, or analysts are influenced more by the outliers because they have to convince a certain class of people, either the investor or the seller.
Hmm.
So while the outlier has only a certain percentile of data or a certain percentage of data, people while doing their analysis or writing their equity research report or doing the scenario analysis do not, I mean, think less about the averages and more about it, more in terms of the scenario analysis. Scenario analysis, to my understanding, is the most bogus concept. We should look at the averages of the three parameters or the three scenarios and
So,
also map it to, and my final sentence for the question, and also map it to what are the capabilities of the company. I can
hmm.
plot a very optimistic scenario, but Taruni, do you build a map or a chart where you plot the optimistic scenario against the present scenario, which is a status quo, which is going as, I mean, as is basis, nothing happens. What
Hmm.
is, so when you do this analysis, when you're doing an optimistic analysis, when you do a worst case analysis, also plot the normal chart that this is what are the capabilities.
Hmm.
The optimistic is an assumption and the worst case is an assumption. And we bring cyclicity or business cycle into the scenario.
Okay.
Every quarter, there is a different revenue and EPS
Hmm.
number that comes out. There is an average to it. I hope you
So,
understand what I'm saying. So there are too many
yes,
things
sir. I have
together.
a small doubt. So, when we talk about revenue projections, so we assume that there is a growth rate to that, right? So, it
Yeah.
will grow. So, exactly how do you know, like, if this is the best case or the worst case scenario? How do
See,
you
one is
determine that exact
if
number?
you have to figure out what part of the business cycle it is in.
Hmm.
Growing, it's
Okay.
matured or decline stage. So the growth rate would be that, which I think works very fine. For matured, for
Okay.
example, for mature companies, it is not more than 2 to 5% and 2 to 3% ideally. For
Hmm.
growing companies, the companies which have come out of their incubation cell, you know, which are growing, which are proven case, like a Zomato is a proven case, Ola Uber is a proven case, Swiggy is a proven case. There, the growth percentages would differ, be 15-20%.
Okay.
But for matured companies like Whirlpool, Nestle, so
Hmm.
that gives you at what growth it can grow. है ना? But that's a sum total of Q1, Q2, Q3, and Q4.
Okay.
Now, how does Q1 here in this quarter compare to the previous Q1 and to the previous Q1 and to the previous Q1? That is cyclicity.
Okay.
And there are averages. It always works around. See, 5% is not an average. I mean, if you
Hmm.
have 100 and 105, if you take an average of it, it still comes between 102 and 2 and 0.5. It
Hmm.
still hovers around average.
Okay.
So if you have a Q2, then you compare it to lot many Q2s. So maybe you compare it to 15, 20 Q2s.
Hmm.
Now, what happens is that sometimes you realize that a company goes through re-rating. For example, it was doing about 7,000 odd crores average quarterly.
Hmm.
Post-COVID, it is doing about 15,000 quarters average. So sometimes
Okay.
7,200 crores, sometimes 7,400 crores, sometimes 7,100 crores, sometimes 6,900 quarterly revenues. But there is a huge dump pre-COVID and post-COVID. So we split the case into pre and post-COVID,
Hmm.
understand what is the overall growth scenario, which life cycle, the product cycle it is based into. So the product growth or the business growth could be anywhere from 5%, 2% to 15%,
Okay.
depending on which life cycle it is. It could be the company's life cycle or it could be the product life cycle. Ideally, you have to look at the product life cycle.
Got
You
it.
launch a new product, it has a certain growth parameter. It goes through a fast growth and then slows down and then declines. That you build into your optimistic scenario, that you build
Hmm.
in worst case scenario, that you build into base case scenario, but it has to come from the previous product launches. In
Okay.
financial statement analysis, Taruni, no one is looking at the history of product launches,
Hmm.
which I think is the biggest uh, lacuna of our training systems. So you have to understand how HUL has launched products in the last 20 years,
Okay.
what cycles they have gone through, and
Hmm.
hence when they come up with a new product which comes out of their R&D labs, then what would be the best case, the worst case? The product has to define the best case, the worst case, and the base case. The product, listen to it very carefully. The product launches have to define. So you have to look at the history, 10, 20, sorry, two decades of history of HUL
Hmm.
to see what was the optimistic case for them. So the number is not a number in your head or it is not an analyst number. Okay. It is a number which come from the best product launch done so far.
Okay.
Just give me one moment. Just give me one.
Yes, sir.
The newspaper is getting delivered, so there is some amount of logistics happening. Today is a Thursday, so the physical copy of the newspaper gets delivered.
Yeah.
Hence, I cannot stop taking the call, even
No
in the
problems.
middle of the call.
Sir, I'll also just come. I'll grab my charger. Just give. Thank you, sir.
हेलो.
Yes, sir.
हाँ. So, so the real question is, and this you would do when you are at the institute. You would
Hmm.
study the product launches in the last 20 years
Okay.
of all top companies that you can think of.
Hmm.
Those companies give you a historical optimistic case, base case, and worst case.
Hmm.
The analyst does a mistake of coming up with some random number on the growth parameter. How do you know this company will do 15%? The managers
Hmm.
are not capable enough. आप कैसे डिसाइड कर सकते हो? है ना? 5% जिंदगी में कंपनी ग्रो नहीं किया, and you want to give it a optimistic case of. So if there is a history to that company, you would ideally look at the product launches. Unfortunately, not a single, मतलब there are few guys, senior guys maybe, and at the basic level to CFA के books में पढ़ा ही, they're not teaching only as to what is the significance of the product launch, those product launch conferences and seminars that happen, and the product launch parties that happen. A
Hmm.
junior analyst should be present there and studying and tracking it for the full life cycle.
Okay.
It's a new thought that I'm introducing. People do it. It is not captured in the books, and you would possibly do it at when you come to our institute.
Hmm.
You would do it for us. समझे आप?
Okay. Yes.
Does it
So,
sound interesting? Yeah.
yes, it is, sir. So I have a follow-up question on this. So let's say like a company is coming with two different products at the same time. So
हाँ.
how will you look at that? How will you project the growth in that
Take
case?
averages of everything.
Okay.
समझे आप?
Yes.
Just give me once again.
Yes.
2, 3, 9. So you would uh, look at all averages
Hmm.
of the past, all products, two products, the same segment.
So let's say it's in the different segments, sir, not in the same segment.
नहीं नहीं,
So
फिर से define कीजिए.
so if there are like two products but in different segments,
Hmm.
so then how will you project the growth rate of them? Will it be done individually or will you compile them together and do it?
See, comparable product आप लोगे ना, you will take comparable product, you will
Okay.
not take random products.
Okay.
So if you are, say, I understand what you're trying to say. You are trying to say that, say for example, any
Hmm.
company, say HUL is largely FMCG. Say for example,
Hmm.
there are two scenarios, and there is a company like Tata which has multiple divisions. Say for example, it is a conglomerate.
Okay.
So there are 4, 5 divisions mixed into it. Division, I'm talking about the word division. Huh? So it has
Hmm.
FMCG mixed into it, it has food and beverages mixed into it, it has IT mixed into it, it has automotive mixed into it. So you'll have to split it division wise.
Okay.
And then do for each of these product launches, and then hence then a sum total, a consolidated projection. So it has to be at the product level.
Okay.
People do at the top level,
Okay.
which is wrong. For
Hmm.
example, let us assume that these companies are not split and separately listed. So there is Tata Consumer, there is Tata Motors, there is Tata Passengers, there is Tata Commercial, there is TCS. All these are separately listed. So one company at a time you can project. It is one product at a time you can project, and then you can take a weighted average.
Hmm.
What is the revenue contribution? If Tata as a company was only one company listed and all different divisions, which are not listed divisions. So you have to value entire Tata, assuming that these companies are not listed and they are not separate.
Okay.
So you will look at the weighted product contribution. The scenario should come from the product launches, the growth scenarios.
Hmm.
Whether the company will grow at 5% or 15% or 2% should come from how their product launches have been, what experiences they have had with regards to product launches. Say one product was launched and it failed.
Okay.
So the worst case will be maybe 1-2% growth and then a decline. So that is your one of the growth scenarios. One product saw spectacular growth. For example, Indica V2 initially failed, but Indica failed, but Indica version 2.0 when it was launched, it saw an amazing level. That becomes your best case, the optimistic case. And then a flattish growth. It has to come from product. I hope you take this very, very sincerely.
Yes.
You'll be able to justify this in the interview.
Okay. So, sir, no, let's go beyond numbers. So, apart from all the fundamentals of a company, what other qualitative factors do you take into consideration?
Leadership
Okay.
and ethics. That's it. So you could have an unethical management, but they deliver numbers.
Hmm.
Good people usually don't deliver numbers. People
Okay.
who are good at heart, they're too soft, they don't deliver numbers. So what kind of company are you investing? Are you investing in the company for social causes, for humanitarian causes, or are you investing in company for money-making purposes? People usually who are good with numbers are usually ruthless.
Hmm.
Think of Steve Jobs, think of Elon Musk, think of Bill Ackman, these names, and think of anyone who know in your circle of influence. You know that he delivers his numbers. He's a very
Hmm.
senior chap, but very ruthless. Doesn't care about emotions. So leadership quality is all about numbers.
Okay.
Okay? And it is not about corruption,
Okay.
right? So if you look at, so there are a couple of parameters within leadership. You can have big how humane the approach is. But before that comes whether the number is you are delivering the numbers. If you're not delivering the numbers, the company will remain a mediocre number, a company. You'll never reach that limit. You'll never reach the maximum potential. So number-wise, leadership under one, the point A or sub under that point A is
Hmm.
numbers. Whether the leadership delivers the number, achieves the number, delivers the number. Second is obviously the employee retention, and third is the human approach to it. You can't kill an employee and then say that I've delivered the numbers.
Okay.
So there has to be fine balance. So these are the three parameters that I possibly look at, right?
So, the next is, sir, when you pick up an annual report of a company, how do you usually navigate through it? And what are the specific sections that tend to reveal more from your experience?
M&DA, so management discussion and analysis.
Hmm.
Okay. The second is the footnotes in the financial statements.
Okay.
So go to the financial statement segment, reporting segment, and read all the schedules or schedules, however you call it, and then the footnotes to these two.
Sir, could you share an example of a company that you analyzed in detail? Like
Yes.
what stood out and how did that translate into the final decision of the investment?
See, I will not name the company because this is not a private conversation and
Hmm.
this is a public. Anything which is Zoom and all is public domain. But I will name the sector. So we have been evaluating a company on the construction segment slash real estate. So real estate residential projects.
Okay.
We have been evaluating and we have been looking at their inventory management principle, which is accounting standards, Indian accounting standard 115,
Hmm.
right? And we have realized are also reading a KPMG paper on that, where we
Okay.
realize what challenges they face in when the inventory gets converted into revenue. So revenue recognition, because of the regulations, there are some challenges in all sectors and all businesses. That's how it has evolved. So you can't blame the accounting standards, or you can't blame the institute for that, or you can't blame India for that. That's how the revenue recognition principle has evolved, but it leads to certain challenges. So and there have some transactions which have happened. So it
Okay.
has brought to our light that how these companies are raising funds, why there is a need to raise funds. So we are working while we are reading the annual report. We are trying to focus on the capital efficiency part of it.
Okay.
So we are now understanding, we have better insights into why the company has raised funds from foreign investors, because there are challenges in revenue recognition principles. So, and there is also a stress on this segment now that we feel, because flats, there are not enough number of flats selling. There is a slowdown in the number of residential units being sold. So why a company takes a certain decision is evident from the annual reports. You have to have very good understanding, Taruni, not about just financial ratios. From here on now, you will try to work on financial statement ratios, which you anyways from a month from now and for the full year will be working with us on those case studies. You will also try and understand the accounting standards related to it.
Okay.
People are being taught half.
Hmm.
And what we are studying from international certification is just crap. So I'm not interested in the US GAAP. I'm not interested in IFRS right now. First, I should know my own accounting standard. It's like
Hmm.
you know English first before you know Hindi or before you know Tamil or before you know Malayalam, uh,
Hmm.
which is, I think, is not correct. Your mother tongue does not become IFRS, or mother tongue does not become US GAAP. First is the Indian accounting standard. So I think the biggest advantage is that you understand the ratios better because you understand the accounting principles around it, because the numbers could look very distorted, the ratios would look very fascinated, it could look very distorted. But only once you understand the boundaries of the accounting standards, you understand why these numbers present a certain scenario in us. It is because, sometimes because it is enforced by the accounting standards,
Hmm.
which people are not being taught again.
Next, I want to ask about your mistakes and your learnings. So, is there an investment or an analysis that didn't go as you expected? And what was your experience and what did you learn from that experience?
Usually, when we listen to someone else, when we go against our gut feeling or conviction, it has led to errors.
Hmm.
And we realize that the eventual gut feeling. So there are two parts to it. Listening to others has led to errors. Not listening to gut feelings and purely relying to the financial statements. Sometimes the business, the feeling, not gut feeling is not an emotional feeling. Like not my feeling that I feel this company will do. No. The gut feeling comes out of an analytical this thing process.
Hmm.
What is that? So when you analyze the business so well, the business model so well, so it's a weightage between the balancing act between the business model versus the financial state. Sometimes the business model is so convincing, but however, it is so convincing that, but however, it does not reflect on the financial statements yet.
Okay.
The numbers don't match. The business looks good, very good. The
Hmm.
business model is convincing. The story is convincing. It does not reflect on in the ratios part. Then you have
Okay.
to choose. And that is where a smart investor or visionary investor takes a call. There are many examples. Once you are at the institute, I will discuss this. Some of them are from the telecom industry, some of them are from the public sector banks, some of them are from uh, the solar sector, solar industry, energy sector, where the numbers were not matching, but people, large investors were accumulating and retailers were missing out.
So, does that mean that is there some other business going inside, or why does that happen? If the business model is very strong, then it should
It takes
like show
time
the
to
numbers.
reflect on the financial ratios and financial statements,
Okay.
especially when it is a turnaround company. It has gone down absolutely in terms of the performance. It is like in the absolutely in the gutter, and someone is trying to revive it. Financial statements take time to reflect, and prices take even longer to reflect.
Okay.
And it takes many attempts to get a company out of absolutely nowhere, get it back on the track. It was already on the track, then it derailed. The whole story derailed. The whole story related to the sector and the company got derailed, and then to get it back on the track, it takes a lot of effort. People do not believe such stories. Numbers reflect, but the prices reflect the truth even much later. So, business model versus financials. It is always the financial business model which will taken uh, uh, which will take the importance, or which will have the importance, or which will have more weightage, or it will take that decision, or that part of the analysis should take lead over the other thing. Just one. Yeah, sorry. So I will hope you'll edit the portions. Maybe you just
Yes, yes, I will.
I'm sorry.
Okay. So the last question is an advisor. So for someone who is actually trying to build a realistic financial projections, what, from your mindset or your point of view, would you recommend based on your experience or how you practice it right now?
But you have to explain in the sense what let's explain
Like, how do you, like, they want to build a financial projection. So how would you tell them, like, how would you ask them to do it? And what is the mindset they have to possess while doing that?
um, dashboards, and I think Claude or ChatGPT can tell you a lot about the dashboard. So
Okay.
first one is dashboard. What goes into the dashboard is a good understanding of sales.
Okay.
And the sales growth should not be a random decision. It has to come from industry experts. So you have to talk to a lot of industry experts. Then the inventory principle. You have to talk to a lot of industry experts.
Okay.
How the inventory flows. Asset utilization, you have to understand at the asset level. So you have to know which machine is being used. What is the machine utilization rate? That you have to figure out. So that's an advice. People do upar ka, just on the top, the
Hmm.
surface of it, Excel, drag it to the right. That's not real. No. Uh, Understand whether the sales will come or not. Point number one. Talk to industry experts. They will tell you, but this is reasonable, this is not reasonable. Understand inventory management principle, because every industry could have a different inventory management principle. Okay. And the third portion is uh, uh, how the assets are getting utilized. So your asset turnover
Okay.
is decided by the machinery, the make of the asset, what kind of machine, whether you bought it from Germany. It's all about the machines.
Okay.
It is not about spreadsheets. So whether it is from Germany, whether it is from Japan, what is the servicing cost, in how many days the parts will come, that affects your asset turnover. Usually the companies have an SLA, service level agreement, of 72 hours.
Hmm.
Not smaller companies, standard companies. So 3 days
Okay.
gone, 3 days of production gone. Critical part. Do you maintain parts for it? So these things you have to consider, that asset turnover is impacted by the presence of the working or the functionality of the machine. Does it
Okay.
really work? That's the question.
So thank you so much, sir, for taking out the time for
Thank you.
this interview. It was a pleasure talking with you, sir.
All right, take care, Tarun. God bless you, and we'll see you
Thank
soon.
you,
Thank
sir.
you, and bye bye.
Yes, sir.
I hope it was satisfactory.
Yes, sir. It was more than satisfactory. Got a lot of insights. I could relate with the topics that are actually being taught. Like the way you said about accounting standards, we do not learn everything. So
Yes.
today we had a class of revenue recognition. So I could relate with a lot of what you're saying.
ठीक है. I will send you this video in a while.
Recording.
You can download
Sure,
it.
sir.
I'll send you in unlisted format. ठीक है.
Sure, sir.
Okay. Thank
Thank
you.
you so much, sir.
Take care, God bless.